Yes, Taman, what is impairment of asset? Why do we need this standard?
It's a fall in the value of an asset. So that in statement of financial position you cannot carry the asset which is having a recoverable amount lesser than the carrying amount.
Can you tell me some of the standards which have inbuilt mechanism for impairment? We've discussed those standards. We discussed IS2 inventories, we discussed non-current assets held for sale. Now if you remember, was
last time you
yes, Manish.
This standard is not applicable to inventory. That's what you had mentioned last time, if I remember correctly.
Yeah, because
Yes.
we are comparing the carrying amount with the net realizable value. Okay. In case of inventories, we compare the amount with net realizable value because we do not use these inventories. They are meant to be sold.
Okay.
Other assets, like if there are any asset under IAS 16 property, plant and equipment, we can use those assets so they have a value in use, and we can also sell them into the market. We can get net realizable value, isn't it? So in case of inventories, we simply compare the lower of cost or net realizable value. Cost is the value at which we record the inventories into the books, and we always record it at lower of cost or net realizable value. So we are not comparing it with net value in use because value in use is not applicable to inventories. For other standards, we also compare, we consider the recoverable amount as higher of these two. Recoverable amount is higher of value in use or net realizable value. So we'll have to touch upon what is the value in use of an asset while comparing with the carrying amount of that asset. And carrying amount is simply the amount at which the asset is carried at in the books.
So it's a historical cost minus depreciation or
the carrying amount. Carrying amount can be the historical cost. The carrying amount can be the revalued amount.
Yes.
If you are using the revaluation model. The carrying amount can be the replacement cost. Carrying amount can be the current cost. Fair value. These are all different values we have, but whatever value we recorded in the books is actually the carrying amount at which the asset is recorded, isn't it? So in inventories, I say that lower of cost or net realizable value. If the cost of the inventories is 2000, net realizable value of the same inventory is 1500. So I'll have to record it at lower of cost or net realizable value, isn't it?
Yes.
Next moment, the carrying amount becomes 1500 instead of 2000. The carrying amount has changed. So next year carrying amount may be different. Is the reason I do not call it historical cost, I do not call it fair value, I do not call it revalued amount, I do not call it net replacement cost, I call it carrying amount. Isn't it? The value at which the asset is shown in the books. Okay. Now if I have shown an asset in the books, there are two ways of recovering this value. When I have shown an asset at 1500, if I show an asset at 1500, what do I mean? What does this 1500 indicate to me?
That's the carrying amount or value in use or amount you can recover if you dispose of these assets.
It simply means that 1500 worth of economic benefits will flow to me.
Yes.
Isn't it? The carrying amount of an asset indicates that 1500 worth of economic benefits will flow to the entity in any form. Any form means either I use it, either I sell it in the market. If I use it, so impairment testing is what? Impairment testing is simply comparison of this carrying amount with the recoverable amount, and recoverable amount is made up of these two things. Higher higher of these two values is your recoverable amount, isn't it? To know your recoverable amount, you need to know the higher of these two values. I suppose that your value in use is 1700. If you sell this asset in the market, you can sell it for 1600. What is your recoverable amount?
1700.
Higher of value in use or net present value, 1700 is your recoverable amount, isn't it? Impairment testing says that the asset at which I have shown, the value at which I have shown the asset in the book should not be lower than the recoverable amount. If the carrying value is lower than the recoverable amount, that means the asset has suffered impairment, otherwise not. So can you tell me whether this asset has suffered impairment or not?
No.
Because the carrying value is lower than the, I can recover more money than the value at which I have shown into the books.
Yes.
Now at what value will you show the asset after this impairment testing? At what value you are going to show this asset? The asset was at 1500. You did the impairment testing, you got to know that your recoverable amount is 1700. Someone has given many answers, so I'll.
It depends on the valuation method you use. If you are using revaluation method, then you will report as a 1700, and you will, the way someone has explained 200, take it to revaluation reserve.
And if you are using cost model, then
you continue to say it 1500.
Yeah, and then do nothing.
I've said that this is recoverable amount. Do I mean that this is the fair value of the asset? Fair value of the asset I'm talking is 2000. Cost to sell is 300. I do anything.
So if you are using revaluation method, you will show it as a $2,000, right?
Yes, I'll not show it as 1700. That means if there is no impairment, I am doing a test of impairment. Test of impairment simply means that is the value at which I am showing the asset, has it impaired? The value of 1500 is impaired or not? It is not impaired, isn't it? I'll continue to show the asset at 1500. Then if I do revaluation, that revaluation is a different story.
Yes.
If I do revaluation or if I keep it at cost model, is a different story, isn't it? I am doing impairment testing, that whether the asset carrying value is worthy of being shown at 1500. It is worthy of being shown at 1500. It has not been impaired. There is no impairment loss, isn't it? There is nothing called impairment profit in IFRS. There can only happen reversal of impairment if we have previously done any impairment loss, if we have previously charged any impairment loss, isn't it? You get it?
Yes.
What if the value in use or net realizable value of this asset is, net realizable value is 1400, value in use is 1300. What will be the recoverable amount?
1,400.
1400 is the recoverable amount. Comparing the recoverable amount with the carrying value,
Yes.
lower of these two will be the value at which I'll show this asset. I'm not, the impairment testing doesn't say that higher of these two values will be shown somewhere. It always says that lower of these two values will be the value at which I'll show the asset into the books of accounts, isn't it? Previously, when I compared 1500 with 700, what I'm trying to compare 1500 versus 1700, I'm always trying to compare lower of these two. I'll continue to show the asset at lower of these two values. Again, when I test this, has the asset suffered impairment?
Yes, impairment of 100.
When I compare the carrying value of 1500 with recoverable amount of 1400, it has suffered impairment of 100. That means the next carrying value, at what value will you show the asset? I'll show it at
1400.
1400. Has suffered impairment or not? Yes.
Yes, $100.
100 is impairment loss. I'll charge to
P&L, income
P&L.
statement.
Okay. So don't get confused. Don't confuse yourself that it is the fair value of the asset. You are simply doing impairment testing. If it says that the assets has been revalued to an amount, that is another story. That is to be taken care of by IAS 16 property, plant and equipment revaluation model. Then IAS 36 is no more applicable. IAS 16 concepts come into picture. You get it?
Yes.
And do you remember what was the rule in IFRS 5 non-current assets held for sale? There again we were not using the asset, but we were bringing the asset to fair value. Isn't it? From carrying value we were bringing the asset to the fair value.
Yes.
There was no net realizable value. It overcomes non-current assets held for sale, surpasses impairment. Isn't it? Because we are taking the asset from the carrying value to the fair value as held for sale.
So there is no impairment required because you are already taking it as a fair value, right?
Yeah, definitely.
So
Whenever there is a transfer, if you remember, whenever there is a transfer from one type of category to another, it is always done at fair value.
Okay.
The transfer from inventories to property plant equipment, or from property plant equipment to inventories, or to investment property, or to non-current assets held for sale, whenever we do a transfer, we do it at fair value. Clear?
So in other words, we can say this standard is not applicable to IFRS 5.
What is the objective of impairment?
To report the assets at the correct value. The actual value you can recover.
At the correct value at which I can recover either by sale or either by use. So there IAS 36 is not applicable because I'm no longer going to use the asset. There also I'm going to recover the value of the asset, non-current asset held for sale, by selling the asset. Isn't it?
Yes.
So the rule of IAS 36 impairment of assets says that I'll compare the carrying value. There's slight difference in it. Carrying value with the recoverable amount. There the term used is not recoverable amount. If the term used is not recoverable amount, that means IAS 36 is not applicable. Because recoverable amount consists of higher of value in use or net realizable value. If I directly use the term value in use or directly use the term net realizable value, then automatically I'm not into IAS 36. That standard in itself have a rule of impairment automatically inbuilt into the standard. Isn't it? I'll not have to take the help of IAS 36 that please come and help me out in this situation. The standard in itself is self-sufficient to deal with this kind of situation. Okay?
Amit, I just have a question on that.
Yes, please.
What is value in use?
Value in use. You bought a machine worth 100,000. You produce goods worth $35,000 every year. Okay. The useful life of the machine is 5 years. That means what? For 5 years, you will be able to sell goods worth 35,000. That means year 1 will give you 35,000 worth of goods. Year 2 will give you 35,000 worth of goods. Year 3 on your best estimates may give you 40,000 worth of goods. Isn't it? Year 4 may give you 47,000 worth of goods. Year 5, that you can produce goods which may be sold into the market at these cash flows. These are the inflows. There may be some outflows to produce it. Isn't it? There may be some expenditure also of running this machine. Anything. Okay.
Basically, the cash flows that I can generate from using this machine.
The cash flows you generate. So net inflows. Net inflows will be, suppose, 30,000 for this year,
Right.
31,000, 37,000, and 47 minus 4, 43, 42,500, and it is 49,500. What is the present value of these net inflows? That you are going to receive 30,000 over 1 year. So I assume that in 1 year you receive 30,000. What is the present value of 30,000 today? You are going to receive 30,000 at the end of 1 year. What is the present value of 30,000 today? I assume certain amount. Suppose 27,000. Okay. I'm just assuming it because you can calculate the present value by using the formula 1 divided by 1 plus R raised to power n. This is the formula for calculating present value raised to power n. So at the rate of 10% for 1 year, you can look, the annuity table is provided to you in examination. At the rate of 10%, do I need to calculate it, the present value table? At the rate of 10%, it will be 1 divided by 1 plus R, that is 1 plus R is 1.1 raised to power n. So it will be, for first year will be 1 divided by 0.909. Okay. For second year it will be 1 divided by 1.21 is equal to 1 divided by 1.21, 0.826, isn't it? So the present value of 30,000 at the end of year 1 will be 30,000 into 9.9, 27,223. Present value of 31,000 which I will be receiving over a period of 2 years. What is the present value today? 31,000 into 8.6. So this is how I suppose I get the present value of 37,000 to be 26,000, 42,000 to be 36,000, and 49,500 to be 39,000, I assume. Okay. And I take the present value of all the net inflows today. 153,893 is the present present value of the cash flows today. So value in use will be 153 893, isn't it? And net realizable value, the carrying value of this asset is 100,000. Net realizable value of the asset is suppose 95,000. How much is the recoverable amount? Higher of value in use and net realizable value. I'll compare 100,000 with
153.
153. That means the asset has suffered no impairment. I cannot take this asset. I bought this asset at 100,000. Can I record it at 153? If I'm using revaluation model, and then I can do so. But that is value in use, isn't it?
Yeah. Can I ask something?
Yes, please.
Yes. See, if you're talking about the manufacturing plant, you know that there are several processes that product goes through it, and say one of the machine you want to test for impairment, there is no way you can get a value for value in cash or value in use. So, for example, these assets value is 100,000 and the life of 5 years, and machine has only used for 3 years. So, can you not just take it as the 2 years as a use in value in use? Because it's next to impossible to identify what is value in use, because the machine only does a small part of the production.
When I say carrying amount, I did not say that it has to be the value at which I bought it. Carrying amount is what? If I say,
Put it at the balance sheet,
if your example 3 years after it, if the useful life is 5 years, isn't it? The carrying value of the asset will be 100,000, or will I reduce the depreciation charge and then only compare it? Definitely, the carrying amount will be after deducting, even if I'm using a cumulative depreciation method, the carrying value of that particular asset will be after charging the depreciation on it. This is the value of it. If I compare the net realizable value.
Okay, so indirectly, because you know, in a complex manufacturing plant, it's very difficult
The answer for your is not what you want to portray. The answer for your query is that one asset is alone not independent of generating economic benefits.
Yes.
One asset alone cannot do anything. This is your query.
Yes. Yes.
Isn't it? So
Yes.
if one asset is not independently able to generate economic benefits, I'll consider asset 1, asset 2, asset 3, asset 4 as part of a cash generating unit.
Okay.
I'll not see to one asset as having been impaired. In that case, I'll compare the cash generating unit, the value of the cash generating unit with the recoverable amount. I'll not compare the value of individual asset with the recoverable amount. I'll compare the value of cash generating unit with the recoverable amount. The value of all the assets.
Got it. Okay, and let's say there is an impairment of 1 million. So then will you allocate to in the proportionate of the assets of the value, or is just one entry will be reported in your
We'll
fixed assets
allocate
block?
the impairment proportionately.
Okay.
Okay, suppose this asset is worth 50,000. This asset is worth 20,000. This asset is worth 30,000. This asset is worth 40,000. You said that we have suffered impairment of 100,000.
Okay, so you proportionately.
Or I say 20,000 impairment. I'll have to charge. So value of asset 1 will be asset 2, asset 3,
Yeah, got the point. Yeah.
asset 4. The total ratio among it is 5:2:3:4. That is 5, 3, 8 to 10 plus 14. 5 by 14 is equal to 5 by 14 into 20,000 will be the impairment suffered by first asset. 7143. So I'll reduce the asset value 50,000 minus 7143. This is the new value of the asset. Isn't it?
Okay.
This 20,000 into 2 by 14. This is the value of the impairment. So the new value will be 20,000 minus 2857 after impairment, the asset 2. Okay. Asset 3 is 30,000. The impairment allocated to it will be 30,000 into 3 by 14. This is the impairment it will suffer. 6429 is equal to 30,000 minus 6429. This is the value of the new asset now. 40,000 is the value of the fourth asset. It will suffer impairment equivalent to 40,000 into 4 by 14. 11429. So the value of the asset will be 40,000 minus 11429. So this will be the new value of all the assets in a CGU. Clear?
Okay.
It may happen that I can clearly know that out of the 20,000 impairment, if I clearly know that impairment related to asset 3 is 7,000, impairment related to asset 4 is 5,000. So what I'll do? I know
You
clearly
take
that
7,
asset
5
3,
separately. Yeah.
in case of asset 3, the value was 30,000. Asset 3 was 30,000. I say asset 3 has suffered impairment of 7,000. The new value will be
23,000.
23,000. I say the asset 4 has suffered impairment of 5,000. Asset 4 was 40,000. I say it has suffered impairment of 5,000. That means it will be 35,000. But the total impairment suffered is 20,000.
Yeah. So raised to divide in a proportionate manner. Yeah.
So 12,000 we have allocated. 8,000 is total impairment was 20,000. 12,000 we allocated. 8,000 is remaining. Remaining is 8,000. 8,000 will be a portion appropriately among 1 and 2. That is in the ratio 5:2.
Yeah.
5 by 7 and 2 by 7. Isn't it? So equals to 5 by 7 into 8,000 is the impairment suffered by them. So this will be the impairment suffered by this. And 2 by 7 into 8,000 is the impairment suffered by the second asset. So the value of new assets will be 50,000 minus 5714. 50,000 minus 5174. 44,000 and 20,000 minus 2286 is the value of the assets. So I have allocated 20,000 impairment over all the 4 assets. So it may happen that all the assets may not have been impaired in the same manner. I know specifically some assets which are clearly impaired. Clear indicators of impairment is? What can be the clear indicators of impairment? You went to the showroom, bought a brand new Mercedes, paying 35 lakhs. And you went to the showroom at 4 p.m. today. Came out of it paying the money 35 lakhs at 6 p.m. A speeding truck rammed into you. You're quite safe, no worries. Okay. But is the car safe? Will you record it at 35 lakhs? Will you?
No.
So this is an indicator of impairment, clear indicator of impairment that your asset has suffered impairment. You cannot record it at the carrying value because net realizable value in the market may not be even 5 lakhs at the moment. Value in use, it is not at all workable, cannot move, 0. Isn't it? So higher of net realizable value and value in use is 5 lakhs. Comparing it to the carrying amount that is 35 lakhs, you have suffered impairment. Isn't it?
Yes.
Now we were discussing that day goodwill. And you yourself said that goodwill cannot generate
Amortize.
economic benefits independently. Like the assets we talk about, there are some assets which are not capable of generating economic benefits independently. Same manner, goodwill cannot generate economic benefits independently. Isn't it?
Yes.
It may happen that we may allocate goodwill to CGU1, CGU2, CGU3. There may be many cash generating units in one business. Isn't it? And I have some purchased goodwill. And purchased goodwill value is, suppose, 90,000. Now if I have many cash generating units into my business, can I allocate this 90,000 over to these various CGUs according to the synergies they benefit from it? Isn't it? Can it happen that I allocate goodwill to CGU1, proportionately goodwill belonging to CGU2, goodwill belonging to CGU3? So when the cash generating unit we talked about will look like this, isn't it? Cash generating unit will look like this. It will have goodwill, it will have asset 1, it will have asset 2, it will have asset 3, isn't it? It will have asset 4. Now I've got to know that when I compare the carrying amount this CGU with the recoverable amount, I got to know that this CGU has suffered an impairment loss of 135,000. Okay. The goodwill amount relating to it was 30,000. Asset 1 was 40,000. Asset 2 was 15,000. Asset 3 was 36,000. Asset 4 was only 14,000. Okay. By what value I'll be impairing each of the assets? Now the rule of impairment says that first of all, first you will impair the asset. You will impair the asset. You clearly know is damaged. That I know that asset 3 caught fire, cannot be used anymore, or has suffered fire, so will require major repairs and then only will be able to get back to work. So first of all, I'll charge the total impairment relating to this asset to it minus 36,000. If I clearly know that this has got impaired, or if I know that this has suffered impairment by a certain amount, it suffered impairment by 15,000, so I'll allocate 15,000 to it, like I did it previously, isn't it? That if I clearly know the impairment related to a particular asset, like asset 3, 23,000, asset 4, 35,000. First, I'll allocate impairment to the asset I clearly know is impaired. Second step is, secondly, I'll charge all the impairment to which asset among them? Goodwill. Secondly, I'll charge all the impairment loss to goodwill. I have 30,000 worth of goodwill. I'll eliminate all the goodwill. Okay. Now, out of impairment loss of 135,000, I have been successful in allocating 45,000. The remaining,
proportionately.
the remaining amount, I'll allocate proportionately on pro rata basis. I hope I do not need to explain pro rata basis to allocate one.
Yeah.
To allocate how much is remaining. 135 minus 45 is equal to 135,000 minus 45,000. I'll have to allocate 90,000 in the ratio. In the ratio 40 is to 15 is to 14. Can you do that? Will you be able to do this?
Yeah.
Allocation of 90,000 over the 3 assets remaining. 52,174 is for which asset? The remaining 3 assets are 40, 15 and 14. Okay, you calculate it, or I'll do it for you anyways, I think. Secondly, we'll charge to goodwill, impair the goodwill. Third step is so the impairment will be 40,000 40 plus 50, that is 50, 69. 40 divided by 69 into 90,000 will be the impairment. 15,000 divided by 69 into 90,000 will be the impairment. This have already suffered impairment of 15,000. This is 14 divided by 69 into 90,000. So the values will be this minus this. The new values. This will be the new value of assets, new carrying amounts in the CGO. Now, can it go beyond the carrying value of the asset?
No.
So that means this will suffer impairment of 40,000.
Zero, yeah.
This will suffer impairment of 14,000, isn't it? The remaining assets will suffer impairment of 0,000. This is again, okay, asset 3 will be at 21,000. Okay.
It's very complex to derive value in use, right? In practical life.
Yeah, that's the only complexity IAS 36 impairment of assets, and that is what companies are avoiding or afraid of IAS 36, impairment of assets. Okay. Value in use is the one reason for it, because they cannot know the expected future cash flows.
Yeah, like in our business, we have got like cranes and all those assets, but then 1 year we don't have any project, the next year we have 3 projects. It's impossible to estimate any value in use.
But still they have to, depending on the situation they'll have to at least, they do, for their planning purpose, they do estimate what are the cash flows they're going to generate.
But then those numbers are generated from the air. There is no basis. You bid for 15 projects, you may get 2 projects, or you may not get nothing, or you get 10 projects, you don't know.
Yeah. So this is how that it turned out to be 0, because I've taken the value more than the value of all the assets. Isn't it? 90,000 was the amount I took, so all became 0. So it clearly means that you cannot take the value below the carrying value of the asset, isn't it? If the value of the asset is 40,000, it is impaired. That is, it is impaired to 0. It cannot go beyond that. You're having asset worth 40,000, you're showing it into the books at 40,000. That means if it's a suffered impairment, the max can happen to it is it has become nil, and it cannot generate any economic benefits for you, isn't it? You get it? So impairment of assets, practically it is almost over. Let's see it theoretically, that what the words say for it to understand. Okay. Meaning of impairment, circumstances that lead to impairment, meaning of a cash generating unit, basis of allocation of impairment loss. I hope you're clear with all the things now.
Oh, one more thing. When do you test for impairment? How frequent?
That's what we're going to do now. Okay. So just wait for 15-20 more minutes. You'll get the answer for it.
Okay.
So this I have already discussed with you, that you bought a car from showroom for 50,000. The moment you take it out of the showroom, a truck comes and crashes the car completely. So hope you understand what is the meaning of impairment now. Has it suffered impairment?
Yes.
Simply an amount by which carrying amount of an asset or cash generating unit exceeds its recoverable amount. Isn't it? If recoverable amount is lower than the carrying amount, that means the asset has suffered impairment. Carrying amount is the amount at which asset is recognized after deducting any accumulated depreciation and accumulated impairment losses thereon. So hope you got the answer for your question, that what if after 3 years the asset's value was 100,000, it has been depreciated for 3 years, the useful life remaining is 2 years. So carrying amount for the purpose of impairment is carrying amount less any accumulated depreciation, less any accumulated impairment losses thereon. Carrying amount is this only for all other assets as well. Carrying amount is considered after deducting any impairment losses or any depreciation charged till date. Now when asset is bought for 50,000, after it has been acquired, depreciation of 10,000 has been charged, and entity adopts the cost model. So what is the carrying value of the asset?
40,000.
An asset is bought for 50,000. After it has been acquired, a revaluation was done which resulted in the value of 75,000. After revaluation, depreciation of 8,000 has been charged. What is the carrying value?
75 minus 8.
That is 67,000. So for the same asset, if you are using different models, the carrying amount may be different.
Yeah.
So the amount which is expected to be recovered by use or sale of the asset, whichever is higher, is known as the recoverable amount. Now a machine was sold by the entity for 50,000 net. Net means fair value less cost to sell. However, if the machine is used by the entity, it would generate cash flows of 12,000 for each of next 5 years. And present value of these cash flows is 45,000. That is considered value in use. So how much is the recoverable amount of this asset?
50,000.
50,000, higher of these two. Fair value less cost to sell means that fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The definition of fair value has been changed. The previous definition was Fair value is an exchange between knowledgeable willing parties in an arm's length transaction, which was misinterpreted differently by different people. So they've given a very clear definition. Amount someone ready to pay in the market at the measurement date, on the day of measuring. The exit price defined under IFRS 9. The cost to sell could include the legal cost, any incremental cost that if you have to incur any expenses to be able to sell it into the market, which would necessarily be incurred if the asset is sold. Gives us net realizable value. Now, determining present value in use, an estimate of future cash flows expected from the asset, expectations about possible variations in the amount and timing of these cash flows, time value of money and risk element, that is risk rate and premium what will be the rate we'll be taking. Normally, weighted average cost of capital is used as the discount rate for calculating the present value of cash flows to calculate value in use. Now, when does impairment loss occurs? When carrying amount is higher than the recoverable amount. Recoverable amount is higher of value in use and fair value less cost to sell. Now, impairment loss in case of revaluation, how it is treated. A machine costing 50,000 is revalued at 60,000. During the year following its purchase, the machine has suffered impairment of 5,000. During the next year, the machine gets further impaired by 10,000. So if the machine suffers impairment, where will I charge this amount of 5,000?
Against the revaluation reserve.
If I have a revaluation surplus, I'll not charge the impairment loss to profit and loss account. I'll first charge it to any revaluation reserve related to asset if I have any. The further impairment of 10,000. Now my revaluation reserve has how much amount?
5,000.
My machine value was 50,000. Machine's value was 50,000. It has been revalued to 60,000. That means the revaluation reserve has amount of
10,000.
10,000. It suffered impairment of 5,000 means that the new asset amount will be
55.
55. Revaluation reserve will be
5,000.
It has again suffered impairment of 10,000.
45,000.
45,000. My revaluation reserve has only 5,000. It becomes 0.
0, yeah. 5,000
5,000
PNL.
will be charged
Income
to
statement, yeah.
profit and loss account.
Yeah.
Clear?
Yeah.
So this is clear as we were on this. Now depreciation on impaired asset. K Limited bought a car 2 years back costing 5,000. Useful life of the car is 10 years. The car is impaired and the recoverable amount is 1,600. Calculate the impairment loss and depreciation for the current year. Now can you tell me what is the carrying value of the asset after 2 years?
4,000.
4,000 is the carrying value. Recoverable amount is 1,600. What is the new carrying value?
1,600.
1,600 is the new carrying value, isn't it?
Yes.
And how much is charged to profit and loss account?
1,400.
Difference. 4,000 minus
4,400
100.
is charged to profit and loss account. How much will be the depreciation for the current year? Now depreciation is always charged on the revalued amount on the remaining useful life.
200. 1,600 by 8 years.
1,600 by 8 years is 200 is the depreciation charge for the current year. So now you're comfortable in dealing with IAS 16 property plant and equipment as well as IAS 36, isn't it?
Yes.
Now mine has started working there, what I'm actually doing. So now we come to indicators of impairment, Manish. You were waiting for them. There are two indicators of impairment. There are external indicators and internal indicators which result in impairment loss. External indicators can be the significant decline in market value of the asset. If you talk about Apple iPhone 4, Apple has launched iPhone 4S, Apple has launched iPhone 5. So that means Apple iPhone 4 must have suffered impairment in terms of technological obsolescence. The significant decline in the market value of the asset. Earlier it was being sold for 45,000. Now in India it is being sold for 26,500. A sharp decline. So that means the asset has suffered impairment because of the external factors. There is changes in technological environment, or external factor may be that Samsung is a rival who has introduced a better product at a lower price, isn't it? So that is an external factor which has indicated impairment. Changes in the legal environment. Earlier they were allowing certain kind of mobiles to be sold into the market. They have put a ban on iPhone 4 into India. So suddenly there will be sharp decline, like the case between Apple and Samsung. Some of the countries did it in favor of Samsung, some of the countries did it in favor of Apple. So wherever Apple lost, they have suffered losses, isn't it? Internal factors may be the physical damage or obsolescence of the asset. That you took the car out of the showroom and a truck rammed into you when you're buying it new. So you know that the car has damaged, isn't it? And if you know the machinery you have bought has caught fire, you very clearly know the machine cannot be used because it has caught fire. There is damage or physical obsolescence to the asset. That is an internal indicator, internal factor of indication of impairment. See, impairment has to be tested annually, but if there is any indicator which wants us to look at these factors before the end of the year, impairment can be done even during the middle of the year. It is not necessarily to be done at the end of the year only. Okay, if there are indicators which tell us that the value of the asset is no more stated to be at what it is shown today, we may do the impairment testing even in the middle of the year. Significant changes have taken place or are likely to take place which have an adverse effect on the entity or the manner of using the assets. So anything internally must have happened which the company feels will not be able to function in the manner it were functioning previously. Can you give me an example? Yeah, Taman, we'll have to do it for a class of assets if you're testing for impairment. If you're testing for a particular CGU, that CGU will be considered as one asset. Now CGU comprises of assets or group of assets whose cash flows are independent of cash flows of other group of assets. I hope you understand what is CGU. That which together can generate future economic benefits, but the assets alone cannot do anything. Let's have a look at it. A bus operator acquires 3 licenses, and it's mandatory that if the bus operator runs buses on all the 3 routes, then only the government will grant the bus operator the license. Now among the 3 routes, 2 routes are profitable, 1 route is not profitable. But it is a requirement that to get all the 3 licenses, the bus operator has to operate on all the 3 routes. If he doesn't operate on the loss-making route, he cannot operate on the other 2 routes as well. So that means operation of all the 3 routes is one cash generating unit.
Okay. So in this case, these 3 licenses will be considered as intangible assets, and then it will be tested for impairment, and one of the license will be 0. There is no cash in use, right?
No, it's not that. If it has suffered impairment, the CGU will be suffering impairment together. We'll compare the carrying value of the CGU with the recoverable amount. Okay. The third license has not suffered impairment. The third license is loss making. It has not suffered impairment. You are a gold merchant. You are having gold worth of crores, But if you are not able to sell it into the market, you can run into losses. But that doesn't mean that you have lost value of gold.
Okay.
Isn't
Okay.
it?
Okay.
Impairment is something when the future economic benefits of the assets you have are less, but you have shown it at a higher amount, then you are actually able to recover it from the market. Got it?
I just have a question. I don't know if it's the right time to ask or should we wait for the events after the balance sheet. Thing is, if the entity gets to know of any impairment after the FS date, then should they adjust for it or just disclose in the notes to the accounts?
I've already given the answer to you that impairment is done not only at the end of the year, but the moment there is an indicator of impairment.
No, I'm saying after the financial statement date. Let's say that they're preparing financial statements of December 31.
Yeah, but if they are, if you get to know of impairment before the authorization of financial statements, you will definitely include it into your, because it is an adjusting event. It will affect the financial statements presented even if you do not include that impairment into the assets. It's like some machine has caught fire after your reporting date, isn't it? You mean that?
Yeah, something like that.
Something like that. So you will include it into your statement of financial position. Because when you publish it, when you publish it, you wish to portray the true and fair view of the financial statements.
Right.
Okay. The cash generating units are formed with group of assets, are capable of generating cash flows independent of other cash generating units. That there can be many cash generating units in one business, are identified consistently from period to period. That means we can say that 4 assets together make one cash generating unit because the 4 assets are helping to generate cash independently of other cash generating units. Impairment loss for a CGU. When the fair value less cost to sell of the cash generating unit is higher than the carrying amount. When the carrying amount exceeds value in use of the cash generating unit. The same rule. You're comparing the recoverable amount. We are comparing of the CGU now, not of a single asset. You are comparing the recoverable amount of the CGU, fair value less cost to sell of the CGU, and value in use of the CGU. You take the higher of these two. If fair value is higher, you take higher amount as the recoverable amount. If value in use is higher, you take that. You compare it with the carrying amount of the cash generating unit and you test it for impairment. Now, steps to allocate impairment loss to a CGU. First, specific asset to the extent it has been impaired. Like I've already discussed this example that if you know that asset is impaired by 15,000, you will allocate 15,000 impairment to that asset. Then the remaining you will allocate to the goodwill. If still there is any remaining impairment to be allocated, the balance impairment loss, if any, to be charged to remaining assets in proportion to the carrying amount. I hope you are able to understand the language now clearly.
It's very clear. Yeah.
What we are doing. Now give me what we are going to do in this. The CGU suffered an impairment loss of 80 million. The loss is generic to the business and cannot be allocated to any individual asset. How will I allocate it?
Pro rata basis.
First, I'll eliminate goodwill. 28 million goodwill will be gone.
Yeah.
Remaining 52 I'll be allocating over A1, A asset 1, asset 2, asset 3 and the generator. And will divide it accordingly. I hope you can do it now. I do not need to do it.
Yeah.
Now it is clearly mentioned that if we know the recoverable amount of some specific assets and we know the impairment suffered by some specific assets. So can you tell me how much is the impairment suffered by asset 1?
10 million.
10 million is the impairment suffered by asset 1. Asset 2.
$34
24 million.
34.
That is 34 million we can allocate directly. Now next step is to allocate to goodwill. 28 million will be allocating to goodwill,
Yeah.
isn't it? So the remaining we will allocate to
A3 and generator.
A3 and generator. On
80, 6.
5 and 2.
Yeah.
that is we have already allocated 24 plus 10, that is 34, plus 28, 34 plus 8 is 40.
68.
How much is remaining? 80 minus 62 is remaining, I guess, which will allocate to A3 and generator. So the total goodwill we can allocate is 80 million only. The total value of the remaining assets should be 208 million. So this is what we learned, meaning of impairment, circumstances that lead to impairment. The only thing which was remaining before starting these slides was circumstances that lead to impairment, isn't it? Which are already completed now, and how we are going to allocate the impairment loss. So this is all regarding IAS 36 impairment of assets.
Amit, what's the frequency that they should test for impairment? I mean, yeah, you mentioned about the internal and external factors, but
Annually.